being updated comes in at 22K, a substantial miss on that number, and on the unemployment rate came in at 4.3, which was the expected number. And so the numbers 100% coming in on the weaker side. So let's look at how the markets are reacting here. So first of all, we are flat, at least initially, on the markets. They were up about 10 points, so giving back some of the early gains. But this is not, at least on first reaction, where there's a big market move. But where is the move? Well, we've talked about the dollar and setting up for a potential thing of what would it mean if to the dollar. We were talking about whether the dollar was capable of a big surprise squeeze on the upside. Clearly, this weak number has started the dollar with weakness. We've remained decisively below this 50-day moving average. It faded and failed at that 50-day moving average, and we're very quickly on the reaction to this, basically coming straight down to the lows of the last month. If we see the dollar break that down, that certainly could start another leg down the dollar. But let's go dig a little bit deeper and actually see what currencies are actually the ones moving it. First of all, the euro, you can see, is the one that had the biggest uptick. You can see that it's already trading back to the top of its trade range from the last month. The big question here is will that euro get that breakout? Look at the pound sterling recovering from its breakdown candle at the start of the week, right after Labor Day. It had that breakdown. The US dollar yen breaking back the breakout candle here that was looking to potentially start a US dollar advance, has been just given back, and the US dollar CAD giving back some of its initial strength. So right now, decisively, the US dollar is giving back all potential gains, still in its trade range, but definitely weakening to the bottom end of this range. So the next thing, let's move on to see what impact this has had on the interest rate markets. And so what I want to start off with here is start with SOFR futures. Now this here is the 2025 December futures. So we're talking about what they're anticipating interest rates to the end of the year. Now, when we were at 96 and a quarter, that was essentially anticipating roughly 375 basis points for rates. With us jumping 10 basis points like this right now, you can see they're on their way to starting to price in a third rate cut. So you can observe here that if this little short-term measured move gets up to 96.50, that extra 25 basis points is basically between now and the end of the year putting in one more rate cut. So definitely right off the bat, we're seeing SOFR futures increasing the probability that the Fed is going to cut a third time this year. The question becomes, if the market is pricing this in, does that come with a surprise in September with the 50 basis point? At this stage, I would say that the more balanced approach would be just 25 basis points each month, each meeting in a row, which would be that September, October, December rate cuts. But to be fully priced in, we're going to need to see these SOFR futures following through. Similarly, when we're now going to the December 2026 SOFR futures, which are now pricing in all the rate cuts from today to the end of next year. So we're talking about 16 plus months. And so another breakout here, what you can now observe is that we're at a level where we were trading during the Liberation Day crisis. And so we're now, the 97 level is essentially the 3% level So that would be close to 5 rate cuts. You can see the market is very quickly moving towards pricing in a sixth rate cut in that window. I still think that this is one of the more asymmetric trades out there because, in my mind, even if the Fed had to stall out the pace of those rate cuts because, let's say, inflation stays sticky, I just don't see them going into a hawkish cycle where they would actually start to raise rates or the market somehow pull all of next year's rate cuts out of the market. So to me, can this thing swing, 40, 50 basis points? Sure. But I also think that we can easily see 100 plus basis points on the upside if the situation deteriorated. So in my mind, this remains an asymmetric trade, even up here on the SOFR futures front. This is still one. This has been one of our higher conviction calls at Big Picture Trading, and we still like it. It's still exciting place. Now look at this. This is the 10-year Treasury yield. Look at this breakdown. Now, yeah, it started breaking down yesterday, but now on this jobs number, a very clear and decisive breakdown as we're seeing yields very clearly breaking down, which is essentially a bond market breakout. This is really interesting because there's a lot of people out there that are quite bearish U.S. Treasuries because of how much government funding is going to be needed, global selling of U.S. bonds, and yet here we find ourselves with the 10-year Treasury bond outright rallying. This is a very clear bull breakout on the upside. It's been rallying for over a month, holding all of its moving averages, it held to a 50% retracement on the Fibonacci zones, and a very clear breakout. So we have longer duration bonds going, and even the long bond. Look at this. Everyone was talking and concerned about the 30-year bond, and yet what a very clear breakout on the upside after what has been a clear basing formation developing here on these bonds. And so while the stock market has seen this big reaction to this jobs number, what is clear is the rates markets and the currency markets are moving on this. That will translate to movement in the stock market inevitably. It's just a matter now of what kind of a lag time and how much of a follow through we see on these before the stock market starts to care. Now, another factor that comes in is gold. Gold up $35 on this reaction. Again, cross currency. Obviously, gold is considered a hard asset cross currency to that US dollar. So, US dollar weakness, immediately a tailwind. Lower rates, immediately a tailwind. Gold slamming back up towards an all-time high. The measured move for gold still remains up towards 3,800 to 4,000, though I wouldn't be holding my breath that it all happens all here in September. The last market rally in gold from its bottom to peak was 160 days. If you even want to measure off of the May low, 160 days out, just a rule of symmetry is to the end of October. So you have to anticipate that that kind of an upside target is probably realistically a 2-month upside target to 4,000, but definitely a bull market going on in gold. It is definitely running and there's room to go. I prefer buying dips rather than rips, but this is a bull market and you should be buying all dips on gold, looking for those upper targets. The silver up 50 cents. What's interesting here, again, there are a number of measured move targets that are coming up to this $43 to $45 level on the upside. But really, when I look at this big picture chart out to the weeklies, the all-time bubble high on silver was up in this $48 to $50 range. And at this juncture, I just don't see how silver only goes to 45 and doesn't go for a full retest of that previous high. And so I think that there is still a solid 10 to 20% upside in silver into the fourth quarter of this year. Now, again, I like to buy dips, not rips. So buying it up at the high I'd rather wait for pullbacks, but you've got to stay bullish silver, and it's not over yet. You want to keep playing this out there. And so, that's where we're at. If any of you have any questions or you have anything that you want to talk about, this is the whole point of doing a live stream, is it's an opportunity for us to answer any of your questions. So if any of you have anything, please type it in, and I'll be happy to address anything on there. Anyway, that's where we're at on this. So let me just check something on my side screen here too. All right. So nonetheless, that's where we're at here on the markets. The S&P initially not making a big move on this. I'm very curious after the market open whether or not this fades. The reason that it's interesting to me, I'm going to put on a 4-hour chart, is we rallied all the way back to previous highs, right? So we're trading up along here on the cash index. That's going to be just a double top along this high. And so the question is, with the dollar, interest rates, all of these things moving the way they are, will the S&P have enough gas in the tank to make a new high? Because if it doesn't, then in fact, it rallying back to the highs will continue to solidify our bigger thesis, which is that this entire rising wedge is the tail end of this bull advance, and that while we're not necessarily bearish looking for another monstrous bear market just yet, what we do respect about the markets is that markets always go through corrective cycles. It's a very inherent nature of the market. And often corrections have direct proportionality to the prior rallies. So when you've gone through a 5 month, 30+% market rally, even a 1/3 reaction, like let's say a 38% retracement of that, is at least a 10+% drop on the market. And that is just it naturally retracing the prior rise. And this is just something that has to be taken into consideration. A 500 or 600 point correction in the market would still just be a correction. It wouldn't be a crash. It wouldn't be, an alarming thing um, cause you to have to panic out of all your positioning. But think of it this way: why would you put new money to work here when there's far better asymmetry waiting for a pullback to get better prices, or even have the opportunity to dollar cost average positions that you already have? Is also a very reasonable time. Like, volatility premiums are still actually very reasonable. The VIX is right back down to the 15 level. Generally, volatility premium, for this being September, a highly vulnerable month, volatility premium to hedge your portfolio is still relatively cheap. So what you have to think about is, like, look at the from a risk to reward perspective, right? Like, what is it that the risk is in this market versus the potential reward? Like, is the S&P without a correction going all the way to 6,800? Like, if it was, and you had an extra 5% upside, you have to weigh that against that if you don't sell on the way up of it, let's say rallying to 6,800, then any first correction will actually have you in the red right after you've gotten in. And so sure, if the market does still have another leg higher, it doesn't make it an exciting time to be putting new money to work here on that front. The second thing that I'm going to be watching here closely is how will this translate into the Nasdaq story. Now notice here the S&P up 16 points or 25 basis points, but the Nasdaq is up 66 basis points, almost more than double on the day. More importantly, the Nasdaq has now managed to rally back up to this previous high, violating this short-term trend line. So one of our kind of things that we were stress testing is that would we see the beginning of a sector rotation, one where there becomes active profit taking in this highly overvalued or fully valued, let's call it Mag 7 and a huge mega cap base place versus some of the very cheap parts of market. Will we see that rotation getting underway? Well, with the Nasdaq up this much, it diminishes the chance that that kind of rotation is the theme, at least right now. And so we're going to continue to see how this develops on there. All right, so the that's where we're on there. Let me just see if there's something else that needs to be commented on. Again, like one of the big clues for me is going to be watching this U.S. dollar yen because it's over the last uh, let's call it 4 or 5 months. This has been the currency that has generally been the strongest and for the US dollar in a sense that it's been hugely rebounding and if there was going to be a US dollar counter trend rally to let's say 101 or 103 on the dollar index, it is very likely that it was going to be on the back of a rally in the US dollar yen. So the fact that this morning we came right for a direct retest of the 50-day moving average is 100% something else you should be watching. Because if in any way the trend now in the post jobs numbers period involves this breaking below that 50-day moving average on a breakdown move, then this entire consolidation could end up of having just been one 50% retracement. And then the bigger question becomes, what if this now suddenly opens up the downside window for actually another full US dollar decline? Now, I'm not highly supportive of this call yet, but I'll tell you, if we break down below the 50-day moving average and we break down below all of these lows, it immediately comes into play as a real possibility and of how things could be playing out. Now that gold and now that gold has started moving, how is that translated again into all the other precious metals? Well, again, silver is up 27 cents right now in the futures, turning higher. Now, how are the other precious metals doing? Well, when we take a look, platinum, what I'm dying to find out is whether or not yesterday's sell day gets bought on dip. There is nothing more bullish than if in the next two trading sessions going into Monday or Tuesday, we get all the way back up to let's say 14 and a quarter, just completely wiping out that sell cycle. That would indicate that it was immediately bought on dip. And it also would be, from a price action perspective, confirmation that the bulls are buying all dips and there's money flowing in here. That would be a support for the idea that platinum can continue higher and actually make a key breakout. Now, palladium has been flirting at its 50-day moving average after doing a Fibonacci retrace. Also, a very key moment to find out whether this thing can break above that 50-day and hold on a big breakout. Now, one of the things One of the things to also watch is is what happens with a stock like Google. Now, Google came out with some very positive news on some of its the lawsuits associated with it, and the stock goes gapping higher. And the big question here, and it's a huge mega cap contributor to this thing. Will this be like what happened on Microsoft's earnings? Will this be one of these scenarios where it's an exhaustion gap and sellers sell into it, where it comes and gives back down to, let's say, 215? If you see that kind of a pullback, then the question then becomes, is that a bigger topping formation, or will it sustain? The most bullish thing that could happen is that this thing stays, let's say, north of 220 on any consolidation. That becomes a midpoint flagging formation for a bull continuation. And that certainly could be a huge supporting factor of money to flow back into the Mag 7 space. Now, let's say like we're talking like let's say Microsoft of the Mag 7s. Now, it's faded off of the earnings gap, but this has all of the telltale characteristics of a typical flagging formation that retraces for a direct retest of the 50-day moving average. And so we have a scenario. We have a scenario where this if this bullishly breaks out of this flagging formation on the upside, then at minimum, you have the potential for a double top retest. Even if it is a bigger picture topping formation, that is a solid 10% upside on a 1 month move for it to retest the 550 area up above. The so just we'll slowly start wrapping things up here, but let's just kind of review everything here. The We basically have a scenario where the job growth is collapsing down to 22K, unemployment rate rising. Uh, you know, is it a 50 basis point cut in September or an extra rate cut in October? One way or another, we have a market that is, you can see in the SOFR futures, that is starting to price in one more rate cut. And it definitely puts it on the table on that. So we obviously have to see how an entire day of trading absorbs into this. And then we're going to really come in Monday and size it up. We'll be doing that live with our members at Big Picture Trading, just getting a really good grasp on what the opportunities that have really emerged in all of this. Those of you that want to watch this type of analysis going on a daily basis and looking for actual individual stock opportunities, can join us at Big Picture Trading with a free trial where we'll be doing this all next week. All right. So the link for that is also going to be in the description below. So again, the S&P initially not reacting. We talked about an implied range of the S&P 500 to within 44 S&P points on the day, and really at this point it looks like the dealers and the price discovery of the market nailed it. It wasn't a big equity mover, but it was definitely started something in the currency and rates markets. And that's important because those markets are huge and they will inevitably translate to movement in the markets. And there's definitely a bull breakout in gold on this, especially on that dollar movement. So that's definitely where a lot of this key action will be. So a lot of this will be in our future videos in the coming weeks. We're going to talk about how to hedge your portfolios, how to protect yourself, and how to capitalize on some of these trends and opportunities that are emerging. So, there's going to be lots of volatility here in September and October. There's going to be some crazy moves. Some big money is going to be made and lost. for those that are watching the charts and reading the tape have the best chance of trading through it. So follow us along, and happy to help you navigate through